Hello and welcome to this webcast on the 5-step revenue recognition model under the exposure draft PBE IPSAS 47 revenue, hereafter referred to as the revenue ED or proposals. I'm Liana van Heerden, Senior Project Manager at the XRB. This webcast is for preparers, auditors and users of financial statements of Tier 1 and Tier 2 public benefit entities, also known as PBEs, which includes both not-for-profit and public sector entities. Today, we'll dive deeper into each of the 5 steps in the binding arrangement revenue recognition model. Before we get into the detail, let's take a step back. The revenue ED introduces 2 accounting models, one for transactions with binding arrangements and another for transactions without. The 5-step revenue recognition model applies specifically to transactions that involve a binding arrangement. To get the most out of this discussion, it's important to understand the concepts of binding arrangement and compliance obligations. If you haven't already, I recommend watching our other webcasts on our website relating to the binding arrangement principle and overview of the revenue ED before further exploring these 5 steps. Now that we've set the context, let's walk through the 5-step model. Step 1. Confirm that the criteria for the binding arrangement model are met. Step 2. Identify the compliance obligations in the arrangement. Step 3. Determine the transaction consideration. Step 4. Allocate the transaction consideration to the identified compliance obligations. And Step 5. Recognize revenue as the entity satisfies each compliance obligation. Starting off with Step 1, which is to ensure the binding arrangement criteria are met. Essentially, we need to ensure that the arrangement is valid, enforceable, and has economic substance. In this step, all 5 criteria shown on the slide need to be met. This means, for example, that all parties must have agreed to the arrangement and be committed to fulfilling their obligations. In addition, the arrangement should have economic substance, meaning the purchaser or third-party beneficiary's future cash flows or service potential is expected to change as a result of the transaction. Once we've confirmed that a binding arrangement exists, Step 2 is to identify the compliance obligations. In other words, the entity's distinct promises in the binding arrangement, i.e. the promised goods or services. These distinct promises could be to transfer the goods or services to the purchaser, a third party, or in some cases to use resources internally. For a good or service to be considered distinct, 2 conditions must be met. Firstly, the recipient can benefit from it either on its own or together with other resources that are readily available. And secondly, the promise can be separately identified from other promises in the arrangement. This step is important because each compliance obligation becomes a unit of account. In Step 3, we identify the transaction consideration. That's the amount of resources the entity expects to be entitled to for meeting its compliance obligation. The transaction consideration can include several components, as noted on the slide. 2 components I want to call out are variable considerations, which can include discounts, rebates, refunds, and so on, and a significant financing component, which may not be explicitly stated in the arrangement but need to be considered when the timing of payments provides a significant financing benefit to either party. The revenue ED contains specific measurement requirements for the different components on the slide. Step 4 is about allocating the total transaction consideration across the identified compliance obligations. The objective is to allocate the consideration in a way that reflects the amount the entity expects to be entitled to for each specific obligation. The revenue ED requires this to be based on the standalone value of each promise, which can be determined in several ways and may include using a market price, a cost-plus markup approach, a residual method for whatever is left, or a combination of these methods. The diagram shows how a total consideration can be broken down and allocated to 3 obligations using different methods, with obligation 3 illustrating the residual amounts. Step 5 is the final stage to recognizing the revenue. Revenue can either be recognized over time if any one of the criteria on the slide is met, or alternatively, if not over time, the revenue is recognized at a point in time, when control of a promised good or service is transferred to the other party and the compliance obligation is satisfied in full. The key idea is that revenue follows the satisfaction of the compliance obligations, either steadily over time or at a single point. We'll now do a high-level walkthrough of an example. In this scenario, an IT service agency enters into a binding arrangement with the government office to provide a piece of IT equipment and installation services for $10,000. In this scenario, it is assumed that the installation service is not complex, could be performed by an alternative provider, and does not significantly modify the equipment. So, with the example set, let's get into the 5-step model. The agency first needs to assess whether the arrangement with the government is binding and that the criteria in step 1 have been met. In the example, the entity concludes that the arrangement is binding. The next step is for the agency to identify its compliance obligations. The agency determines that there are 2 distinct promises. Firstly, providing the equipment, and secondly, performing the installation services. The agency would be able to satisfy its promise to transfer the equipment independently of its promise to provide the installation services. Therefore, each promise is separately identifiable and the government can benefit from it on its own or with other readily available resources. Step 3 is to determine the transaction consideration. In our example, this is the $10,000. Per step 4, the transaction consideration should be allocated to the compliance obligations on a stand-alone value basis. We'll assume the equipment has a price that it trades for in the market of $9,000, and the installation services are allocated the residual amount of $1,000. That leaves step 5, recognizing revenue. In our example, the equipment revenue is recognized at the point in time when control of the asset is transferred to the government. For the installation services, assuming it doesn't satisfy the criteria for recognizing revenue over time, the $1,000 will be recognized at the point in time when the installation is finalized. Now that we've worked through the 5 steps, this slide highlights each step's requirements in the proposed standard, with further detail provided in the application guidance. In addition, the Revenue ED includes illustrative examples that highlight some of the key challenges entities may face, such as identifying distinct obligations or accounting for variable considerations. Together, the requirements, application guidance, and illustrative examples gives entities a structured framework while also providing practical tools to address real-world complexities. That brings us to the end of this webcast. You can find further webcasts and other educational material on our website. Important to note that ED PBE IPSAS 48 transfer expenses is also currently being consulted on. We would love to hear your feedback on the proposals in the revenue and transfer expense EDs, so please keep an eye on our website for events and other information relating to these consultations. And please note that these consultations close on 1 December 2025. Thank you and goodbye.